Welcome to the deep dive.
Good to be here.
So today we've got a real head scratcher. A major bank, Wells Fargo, reports fantastic earnings, beats forecasts.
And the stock price drops.
Exactly, what gives? So our mission today is to really unpack that. We'll look at their Q2 earnings call, some news reports, their financials.
And figure out the story behind the numbers.
Right. Let's dive in.
It's one of those classic market puzzles, isn't it? You see great numbers, but the reaction is negative. Usually means there's something else going on.
For sure. And with Wells Fargo, you almost have to start with the elephant in the room, the asset cap.
Oh, absolutely. That thing hung over them for years. Since, what, February 2018?
Yeah, imposed by the Fed because of all those, well, scandals, the fake accounts, the insurance stuff.
Right. Serious consumer abuses.
Mhm.
And that cap basically froze their growth, kept them from getting bigger than their 2017 asset size. A huge constraint.
But the big news, the really pivotal news, is that the Fed finally lifted it, June 3rd, 2025.
Yep. Fed Governor Barr called it a pivotal milestone. Said Wells Fargo did the work, met the standards. So the chains are off, so to speak.
Took a while.
It did. And CEO Charlie Scharf, he sounded realistic about it. Said something like, "We are a far stronger company today."
Right, but he also cautioned it's not like flipping a switch.
Exactly. Not like this light switch is going to go off. He said the changes, the growth, it'll happen over time.
Yeah.
It just opens up options now.
Okay, so options. What kind of options does this newfound freedom give them? What changes now?
Well, a few key things. They can actually try to grow deposits again, proactively.
They had to turn business away before, right? Especially corporate money.
Yeah, they did. Now they can take it on. Plus, they can put more capital towards growing loans,
Yeah.
especially in corporate and investment banking.
CIB, yeah.
And just generally let their balance sheet expand for their markets business, trading, investment banking activities. Before, they had to be super careful about even committing to new loans.
Makes sense. And seems like they marked this moment internally, too.
They did. Gave a special stock award to all employees,
Huh.
over 212,000 people. Kind of a thank you for getting through it.
That's significant. Though it's interesting you mentioned headcount. Hasn't that been going down?
Oh, yeah. For 20 straight quarters, headcount's down like 23% from 5 years ago.
Yeah.
So while celebrating the cap lift, they're still very focused on efficiency. It's been a massive overhaul.
Okay, so asset cap gone, efficiency drive ongoing. Let's get into the Q2 numbers themselves because they look really strong, which makes the stock drop even weirder.
Totally. The headlines were great. Earnings per share, $1.60. The forecast was, what, $1.40?
Yeah, beat it by over 14%. Solid.
And revenue, too, came in at $20.82 billion, just edging out the $20.76 billion forecast. Net income up almost 12% year over year, $5.5 billion. Good numbers.
Profitability looks good too, right? ROTCE.
Yeah, return on tangible common equity hit 15.2%. That's a solid return.
15% on a GAAP basis. And they're bumping the dividend.
Mm-hmm. Up to $1.45 a share expected for Q3. 55 years in a row of paying dividends. Quite the track record. Shows commitment to shareholders.
Definitely. And they're growing in key areas too, it seems. Loans are up.
Yep, loan balances grew $10.6 billion higher than last year and up 1% just from Q1. Mostly driven by that corporate and investment banking push.
And digital. Everyone's focused on digital.
They are too. Over 32 million active mobile users now, up 4%. And more people are opening checking accounts digitally.
But they're not abandoning branches either. I saw something about refurbishing them.
Right. They're actually investing there too. Plan is to redo over half the branches by year end and the whole network by end of 2028. Plus expanding in places like Chicago, NYC, Nashville.
Interesting balance, physical and digital.
And investment banking fees look good too, up 16% in the first half of the year, gaining some market share there.
Okay. And credit quality. Any worries?
Seems okay for now. They reported lower net loan charge-offs, consumer delinquencies improved. Commercial credit performance was called relatively strong.
So, let's recap. Asset cap gone, stellar earnings beat, good revenue, solid profitability, dividend hike, loan growth, digital growth, branch investment, good credit.
And yet,
the stock dropped almost 3% pre-market. Traded down to $81 from a high near $84. This is the core of the puzzle.
it really is. If everything looks so good, why the negative reaction?
And the key, it seems, lies in one specific piece of guidance. Net interest income, NII.
Ah, yes, NII. The difference between what the bank earns on loans and pays out on deposits, basically.
Exactly. And Wells Fargo lowered their outlook for NII for the full year 2025. They now expect it to be roughly in line with 2024's level.
which was about $47.7 billion.
Right. And previously they had guided for like 1% to 3% growth. So that's a definite cut in expectations for that specific line item.
Okay, so the market seized on that NII guidance cut. But is it actually a sign of weakness or something else?
Well, this is where it gets nuanced. According to the CFO, Mike Santomassimo, it's more about strategy. They're choosing to put more of their balance sheet to work in their markets business.
Trading investment banking activities.
Right. And while some assets there might not earn direct interest, the revenue, the fees, the commissions shows up elsewhere in non-interest income.
Ah, so they're optimizing for overall profit, maybe through fees, not just maximizing NII specifically. It's a shift in how they generate returns.
That seems to be the explanation. Trading fee income for interest income, in a sense. And they have the capital strength to do it. Their CET1 ratio.
Common Equity Tier 1, key capital measure.
Yeah, it's strong. 11.1%, way above the 9.7% minimum they need right now.
Plus, their extra capital cushion, the stress capital buffer, is expected to go down.
To 2.5, 2.6%.
Right, which means lower capital requirements in the future, more flexibility.
And all that capital strength lets them return a lot to shareholders, right? Buybacks.
Huge amounts. Over $6 billion in stock repurchases just in the first half of the year. And they authorized another $40 billion program. That signals real confidence from the board.
Alongside that, they're still hammering away at expenses. Those 20 quarters of headcount reduction, that's discipline.
Definitely an ongoing theme. Efficiency. And they're looking at things like AI too, though the CFO is pretty cautious there.
Yeah, sounded like very early days for AI impact. Some pilots, some early benefits, but nothing huge yet.
So looking forward, with the cap gone, what's the plan?
Scharf basically said move forward more aggressively. Serve customers, businesses, communities, support economic growth.
Which means going after deposits more, growing loans selectively,
Yeah.
but still being careful, right? Given the economy.
Exactly. They see consumers and businesses as strong right now. Low unemployment. Inflation's sort of okay, but they acknowledge risks.
Always risks. Economic uncertainty, inflation may be ticking up again, regulations changing.
Intense competition, too, especially in banking and credit cards and global stuff like tariffs.
Yeah, competition stuff, particularly from other big banks in that middle market commercial space.
And speaking of streamlining, they sold off their rail leasing business.
Yep, sounds like that was the last big piece they wanted to divest, focusing the business mix now. Makes sense. Get rid of things that don't meet the return targets.
So when you pull it all together, what's the key takeaway for you, for our listeners?
Well, it's a really fascinating story, isn't it? Wells Fargo battled through this huge regulatory burden with the asset cap.
Yeah, for years.
Got it lifted, posted really strong results operationally, but then made a strategic shift that spooked the market on one metric, NII.
Even while signaling massive confidence through buybacks and dividends.
Exactly. It really shows how complex these big bangs are and how market reactions aren't always straightforward. Sometimes you need to look past the headline number, the headline reaction.
It's a reminder to dig deeper than the initial stock tick.
Definitely. And it leaves us with a pretty interesting thought. Wells Fargo is now essentially unchained. They're leaner, they've got capital, the cap is gone, they're aiming to compete aggressively again.
So the question for you to think about is, what does this comeback story, this transformation signal about the long game in finance? And maybe more importantly, how are competitors going to react now that this giant is fully back in the ring?